Hey everyone, welcome back to Corporate Decoder, the place where we break down the complex world of business. And today we're diving into Western New England Bancorp's latest financial report. And let me tell you, there are some interesting numbers in here that tell a pretty clear story. So what are we looking at here? It is a quarterly report, a 10Q from Western New England Bancorp, incorporated, also known as WNEB. This report wraps up their financial performance for the period ending last September. Think of it as a snapshot of their health right in the middle of the company's year. Before we get going, if you like getting straight answers from these kinds of documents, make sure you are subscribed. We also have a Discord community linked in the description below where we chat about these filings. Alright, let's jump straight into the numbers that matter. Looking at their balance sheet, which is like a company's financial snapshot, we see their total assets grew to over $2.7 billion by the 30th of September 2025. That is a nice increase from the end of the previous year. A big chunk of that growth, about $60 million, came from their loans. Their total loan portfolio is now over $2.1 billion. This shows they are lending more, which in theory should lead to more income, but we'll see how that plays out later. Interestingly, their total loans figure is over $2.1 billion. This is a key metric for a bank, showing how much money they've lent out. It is up from December of last year, which is generally a positive sign for a growing bank. However, you always have to look at the allowance for credit losses too. That is the money they set aside just in case some of those loans don't get paid back. This allowance bumped up slightly to around $20.5 million. This means they are being a little more cautious, which makes sense given economic uncertainties. Now let's look at how they made their money in the last quarter. They brought in about $30 million in interest and dividend income. That is up from the same period last year, which is good. But their interest expense also went up, though not as much. The difference, called net interest income, came in at about $18 million for the 3 months ending in September 2025. This is a pretty decent jump from last year, showing they are managing their borrowing costs better than their lending income is growing. This net interest income jumped over $3 million compared to last year, a solid 22.8% increase. This is the core of a bank's profitability, and seeing this number grow is a really positive sign. It means the difference between what they earn on loans and securities and what they pay on deposits and borrowings is widening in their favor. They also set aside over $1.2 million for potential loan losses in this quarter. That is more than they anticipated last year. As we saw with the allowance for credit losses, they are being a bit more careful with their money, setting aside more for potential bad loans. Their non-interest income, which comes from things like fees and services, stayed pretty flat at around $3.1 million. This area isn't showing much growth right now. On the flip side, their expenses went up by about $1.4 million to nearly $16 million. A big part of that increase is in salaries and employee benefits, going up close to $1.1 million. This could be due to hiring more people or increased compensation costs. So even though their interest income grew, their costs went up too, which squeezed their profits a bit. Overall, their income before taxes was about $4.2 million, a nice increase from last year. After taxes, they made about $3.2 million in net income. That is considerably better than the $1.9 million they made in the same period last year. This translates to about 16 cents per S-share for this quarter, up from just 9 cents last year. That is a healthy climb, showing they are becoming more profitable on a per-share basis. Looking at shareholders' equity, the value of what the owners have in the company, it increased to over $243 million. This is a good sign, showing the company is building value. However, there is something called accumulated other comprehensive income or loss. Right now, it is a loss of over $17 million. This often relates to changes in the value of investments the company holds, and in this case, it is a negative mark. It is not directly impacting their profit, but it is a part of their overall equity value. This is where we see that other comprehensive loss detailed. It is mostly tied to unrealized losses on their securities that are available for sale. While these are paper losses, they do reduce the overall equity of the company. Let's talk about their investments. They have a big chunk of money, over $373 million in investment securities. A good amount of this, over $179 million, is classified as available for sale. The rest, over $193 million, is labeled held to maturity. Now, here is where it gets a little tricky. They're showing significant unrealized losses in their investment portfolio. For available for sale securities, these losses are over $24 million. And for held to maturity securities, the losses are even bigger, over $32 million. This means the value of these investments has dropped considerably compared to what they paid for them. For some of their held to maturity securities, like government-sponsored mortgage-backed securities, the loss is almost 17% of what they paid. For available for sale securities, it is almost 17%. This is a big number. And it is a major contributor to that other comprehensive loss we saw earlier. They attribute these losses mainly to interest rate changes, not because the underlying companies are in financial trouble. They believe these investments will recover their value as they get closer to maturity, and they don't plan to sell them just yet. But still, seeing such large unrealized losses is something to watch closely. Back to loans, which is their main business. Their commercial real estate loans are the biggest category, totaling over $1 billion. This is a significant amount, and it represents about half of all their loans. A large part of that, over $877 million, is in non-owner occupied commercial real estate. This means loans for properties that aren't used by the business that took out the loan. This is an area that regulators are keeping a close eye on, especially with shifts in the economy and work from trends affecting office spaces. They define their exposure to this sector. Their total commercial real estate loans make up over 50% of all their loans. This is a considerable concentration. They explain that regulators look closely at banks where CRE loans are over 300% of their capital. Western New England Bancorp is right around that mark, which means they are under that regulatory spotlight. They emphasize their experienced team in risk management, but it highlights a key risk area for the bank. Looking at past due loans, the numbers seem relatively low. Only about $4.5 million in loans are currently past due, which is a tiny fraction of their total loan book. And non-accrual loans, where they've stopped counting interest because payment is unlikely, are also very low, around $5.6 million. This suggests that despite their large commercial real estate exposure, their borrowers are generally keeping up with payments. They also have goodwill on their books, over $12 million, primarily from an acquisition in 2016. Goodwill is basically the extra value paid for a company above its identifiable assets. It is regularly checked for any signs of losing value, and so far it seems to be holding steady. They also have a core deposit intangible, which is being amortized over time. Let's briefly touch on their employee compensation plans. They use restricted stock awards and incentive plans to reward their executives and directors. They have detailed metrics for performance like return on equity and earnings per share that determine how much of these awards vest. This ties their leadership's compensation to the company's success, which is a common practice and generally a good sign for shareholders. Now, for a more complex topic, derivatives, they use these financial tools, primarily interest rate swaps, to manage risks. Some of these are designed to protect against changes in fair value, and others are not. They are holding about $5 million in derivative assets and liabilities. These are mostly related to customer transactions. This section dives deeper into how they value their financial instruments, especially those that don't have readily available market prices. They use different levels: level 1 for things with direct market prices, level 2 for things valued with models using observable data, and level 3 for things where they have to use more judgment and less observable data. Most of their investments are in level 2. Meaning their values are based on pretty solid market information. It is in this section where we see some of the most important numbers for their securities held. To maturity, their reported book value is over $193 million, but their estimated fair value is over $161 million. That is a difference of more than $32 million in losses. For securities available for sale, their book value is over $179 million, but the fair value is much lower. Again, these are unrealized losses, meaning on paper, the investments are worth less. They mention their goodwill valued at over $12 million, originating from an acquisition way back in 2016. This is pretty standard for companies that have grown through buying others. In terms of loans, their commercial and industrial loans are also growing, up by over $7 million to $218 million. Consumer loans, however, seem to be shrinking slightly. This section really spells out the risk in their commercial real estate loans, especially the non-owner occupied ones. They are right at the edge of regulatory caution levels for these types of loans, meaning they have a significant concentration in this area. They acknowledge this and talk about their risk management practices. But it is a fact that a large portion of their lending is tied to commercial real estate. On the other side of the balance sheet, their deposits have grown to over $2.3 billion. This is their main funding source for making loans. A good portion of this growth comes from what they call core deposits, which are deposits that are less likely to move quickly, like checking and savings accounts. This is a positive sign, as it means their customers are sticking with them. Their total borrowings have actually decreased slightly, which is a good thing. It means they are relying less on borrowed money and more on customer deposits. Even with the unrealized losses on their investments, their capital ratios remain strong. They are well above the regulatory minimums to be considered a well-capitalized bank. This suggests they have a good buffer to absorb potential future losses. Looking at the 9-month picture, their net income is up to over $10 million compared to about $8.4 million last year. This indicates that despite some challenges, the company is generally moving in the right direction financially. Their net interest income, which is a key measure of profitability for banks, has grown significantly, reaching over $51 million compared to about $44 million last year. That is a nearly 15% increase, and it is driven by both more loans and better rates. Their net interest margin, the profit they make on their interest earning assets, has also improved, now sitting at over 2.7%. This demonstrates their ability to leverage their assets effectively in the current interest rate environment. However, the provision for credit losses for the first 9 months of the year jumped significantly to over $800,000 compared to just $97,000 last year. This again points to a more cautious outlook on loan quality. They also reported net recoveries for the 9 months, meaning they recovered more on old bad loans than they had to write off this year, which is a positive sign for their loan management. Now, looking at the very end of the filing, they have all the necessary certifications confirming their financial reporting. And importantly, they have the inline XBRL files, which means all the financial data is available in a machine readable format for easier analysis. So what is the overall story here? Western New England Bancorp Incorporated is showing good growth in its core banking business with strong net interest income and improved profitability. Per S. Hare, their deposit base is solid and growing, and their capital levels are strong. However, there are a couple of key areas to keep an eye on. First, the significant unrealized losses in their investment securities portfolio, while attributed to interest rates, are substantial and do impact their overall equity. Second, their heavy concentration in commercial real estate loans, particularly non-owner occupied space, puts them in a position that regulators are watching closely. While they've managed these risks well so far, any significant downturn in the CRE market could present a challenge. Overall, NEB appears to be a reasonably well-managed bank that is navigating a complex economic landscape. They're growing their core income streams effectively, but the company's big bet on commercial real estate and their investment portfolio's paper losses mean there are definitely some risk factors to monitor. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.